Okay, greetings everyone. A happy Friday to you. Today is the 15th of May 2015. And wow, isn't this year going by quickly? I'm Rob Colville, owner of thelazytrader.com, a trader trading service dedicated to helping time-strapped individuals trade from as little as minutes a day. Today, on behalf of FX Street, we're going to be covering strategy, basically, on how to successfully trade key reversals. And they're essentially, to all intents and purposes, different styles of trading out there. You've got trend traders, you've got reversal traders, you've got breakout traders, you name it. There's strategies out there according to your personality, and where a lot of people do well in trading is identifying a strategy which suits them. Now, key reversals, I don't know if many of you have actually traded them before. More often than not, they lose than they win. But the ones that do win, if you're in the game, are the ones that make a shed load of money. And what we want to do is essentially capitalize on those winning ones the most. Okay, so it's one thing to have like one winning reversal trade out of, say, 2 or 3. But what we want to do is milk that winning reversal trade for all of its worth. And this is exactly what I'm going to talk to you today about, okay? We've got 45 minutes, and I'm going to basically cram in as much as possible. Feel free to ask questions. There's no such thing as a silly question. Just have a starter disclaimer here. So we're just going to start from the top down. What we're going to cover is identifying the level power zone, identifying a price action reversal, the pullback, and managing the trades. There are 3 opportunities in a key reversal for us to find a trading opportunity. Okay, and this really is on a par with our set and forget mantra, where we can simply trade this on the daily or the weekly time frame and do very well from just standing away from the charts and just doing something slightly more interesting in the daytime, like going to the gym, hobbies, seeing friends and family, rather than just getting boggle-eyed in front of like an intraday chart, because we want lifestyle as well. I'm going to cover several key examples with you, okay? I'm just going to give you a sight of one of these key reversals right now before we go back to the main presentation. And this is pound New Zealand. This cross-currency pair. I know there's a lot of snobbery going around these days about, I only trade cable, I only trade euro dollar. Well, guess what? Exactly the same technical setups occur on these cross-currency pairs that they do the majors or the minors, okay? So don't discard a currency pair just because it might not seem like the in thing. All right, so this is pound New Zealand, a decent cross-currency pair. We can see here we've got a very decent range here, and a well-established level of resistance, also known as a level of supply. Correlating with a round number here, 2 spot 100. We've got 2 decent tests, 1, 2. So the likelihood is that price is going to get to this horizontal level, and there's going to be, something's going to happen. It's either going to break for it or it's going to reverse off it. All right, but given that previous 2 examples here, that price has ricocheted off it and gone back down again, we can reasonably assume that it's going to happen again. Okay, so what typically would happen, you've got people who trade levels of supply and demand, also known in our syllabus as power zones. What they'll typically do is have an order to sell on the level just below it, with their stops 50 to 150 pips away, like so, in anticipation of a move down. And even if you're targeting, say, halfway down in the range here, say you're targeting 1,100 pips divided by 150, that's a 7-to-1 reward to risk trade. Okay, 14 to 1 if you're risking 2% of your trading account. All right, but that's, to a lot of people, that's quite a dangerous way of doing it, because you're not relying on a price action based confirmation. And these price action based confirmations, which underpin or affect the psychology of human behavior, are what a lot of traders prefer to wait for. Okay, so we've got the most aggressive strategy is to sell. This in our syllabus is known as a power zone. So typically the more aggressive trader will have an order to sell on the level here, a horizontal level of resistance, one which is qualified by the fact that it's tested twice before, and will have their trade short. Okay. However, a slightly more cautious trader will actually wait for a price action based confirmation, like a bearish pin bar reversal here. What they could do is simply trade the break of the low here, stop loss above the high, and just trail for every second seller bar. And this, again, is on a par with our strategies. in our standard pin bar reversal strategy, if you're trading it for every second seller bar, you can do pretty well here. I mean, it's an aggressive way of trading it, but as you can see here, you can trade it for every second seller bar, and you can go right back down to the middle of the range, the midpoint, a higher probability, slightly lower reward outcome than taking it all the way to the bottom, which is, of course, a higher reward, lower probability outcome. Okay, but so I've given you two ways of trading this based on your appetite for risk. The first one, where you just simply have your order on the level and your stop loss above the level, which is the most aggressive one. And the second one, of course, which is where you wait on a price action based confirmation, okay, with the bearish pin bar reversal. Okay, but what if you can do both? And there's nothing wrong with actually doing both, okay? Who says you can't have it all? Well, obviously a Puritan, because as I'm going to demonstrate to you, you can have it all. So you can, if this reversal does actually work out, and what you can do is simply double up on this trade without actually risking more in your trading account than is necessary. Okay, so if you're to take both bites of the cherry and trade both strategies, what you could do is simply place your order, like I mentioned, on the level, and your stop loss, say, 150 pips away. And as soon as you do get a price action based setup, what you could do is move your stop loss for the first trade to break even on the level. Then you can place trade number two. So before you place number two, you've already got trade number one in progress and a small profit at break even. It's a free trade. So if the market goes against you, you've lost nothing, okay? But you're still in the game. So you've got the opportunity to potentially make 7% or 14% if you're risking 2%. But in addition, you've also got this extra trade near the start of the actual pivotal reversal point up here. Okay, so you can essentially risk 1 or 2% in your trading account on this new setup here. Okay, so this is the pin bar strategy as well. So you've got not only the free trade based on the levels, you've got your second trade also in progress. And of course, as I said, you'll be trading for every second seller bar as your trade is in progress. So you've got one free trade and you've got another trade making a decent amount of profit. So you've essentially doubled up on the profit potential on this trade without overexposing yourself to the markets. Okay, hopefully that makes sense to everyone. I know I've thrown you all in the deep end here with an example, but I really do like real life examples more than hypothetical examples with perfectly drawn diagrams. Okay, so I'm going to go through some theory now with you, just so that we can do a bit of housekeeping on how these strategies actually work. If anyone isn't sure what I'm talking about, please don't be shy. I don't bite hard, but I have been known to bite sometimes. Anyway, so the supply and demand strategy is very straightforward. Okay, we're going to talk about the selection, timing, management of it. All right, the great thing about this one is that we can get into moves, big moves very early, and benefit from a free trade very early as well, like I mentioned. And of course, piggyback the big dogs where they have their orders, like at these key round numbers, like I mentioned, we saw on pound New Zealand. Okay, so few barriers to entry, fewer rules. All we need are two previous tests on a previous level of support and resistance to qualify the level. Okay, and these can typically happen at multi-year highs, whether it's a 5, 10, 15, 20 all-time high or low. They're all as good as each other, providing the levels has held for two previous touches. Okay, this style does epitomize set and forget at its highest nth degree, and we can apply this logic to all asset classes, regardless of whether it's a currency, a stock, an indice, or, well, anything really, for that matter. I'm sure you could even apply it to the prices of tulips back 200-300 years ago in Amsterdam. Price action based on, well, underpinned by Japanese candlesticks, and no matter what the asset class, seem to reflect the same human behavior. Okay, but anyway, let's move on. So like I've mentioned, a hard level of support or resistance, supply and demand, as a level which has been tested for at least 10 months, and it's got two previous tests. Okay, that's the kind of level we should be looking at here. Like with pound New Zealand, this would be our level to sell here with our order on the level, stop loss 50 to 150 pips away. The bigger the distance between your entry and the stop loss, the safer the trade's going to be. But of course, you do sacrifice profit potential when you have a huge wide stop, of course. Okay, so there's pros and cons like there is to anything in life. All right, just like this level of support here, we've got 1, 2 tests. The third test is our opportunity to buy. And of course, lo and behold, you've got an opportunity to buy here. All right, so this is trading the power zone strategy. I'm just going to give you a brief run through. I know I've talked about this at length in previous webinars. But just to really kind of, you get the gist of it. It's very simple stuff. All we need is two previous tests of a level of resistance or support before we can sell or buy respectively. So this is pound CAD. You can probably see a pattern. I really like pound cross pairs. No shame in that. I'm a Brit and I make no apologies for that. So we've got a sell opportunity here, here, and here. Lo and behold, based on the fact we've got two tests, this point here, and we've got a buy opportunity on the third bounce imminently with this perfectly held range. And if you look on the weekly or even the monthly on a lot of these cross-currency pairs, you will see a lot of range-bound markets. And these are the kind of ones we like because where we've got key levels of supply and demand, we've got decent selling and buying opportunities. Okay, so hard levels occur at round numbers, multi-year high and lows, 5, 10, 15, 20 years, all-time highs, or levels defended by central banks. Look at pound CAD here, in a closer view. We can see here that the market has beautifully oscillated between these two key levels here. So we can reasonably expect when price comes down to this horizontal level of support that the market's going to ricochet off it. And the aggressive trader trading the power zone strategy, which we teach our clients, based on supply and demand levels, will typically have their orders to buy on this horizontal level here if they didn't already here at this point, like so. Okay, so same with the FTSE. We had a great time trading the FTSE last year as it just really bobbled along its penultimate all-time high. And it was just a simple, easy, effortless case of selling at this horizontal level here of a stop loss 50 to 100 points above it. And, you know, sometimes when you get well-established ranges, that's all that we have to do. Nice and straightforward. And rest assured, we can apply this to stocks, currencies, or commodities. There was a great trade we had on Stagecoach, which is a British FTSE 350 stock. And lo and behold, it behaved like it was anything else. We just simply bought at a very well-established floor and price moved off it. Okay, so lo and behold, this is the US dollar versus the Polish zloty. Told you I did it exotic. And yeah, so we've got the second test here, confirming the level or the floor, whatever you like to call it, support. So yeah, third test is the buy opportunity. So people who want to be aggressive and get into this potential reversal trade at the beginning would simply have their order on the horizontal level and their stop loss 50 to 150 or even 200 pips away, depending on their risk appetite. Remember that the smaller the distance between your entry and your stop loss, the more aggressive you're going to be, the more likely you are to be stopped out. But if the trade goes in your favor, the higher the profit potential is going to be. Okay, so in terms of locking in profits, all we do, and please bear in mind this is a whistle-stop tour of this strategy, given that we do have time limitations. There's a lot we want to cover today. We just trail it for every equivalent number of pips it's gone in its distance or in favor of the trade. So, for example, if we've got 100 pips distance between our entry and our stop loss, then if the trade is 200 pips in profit, we move our stop loss to break even. If the trade is 300 pips in profit, we move our stop loss to trailing 100 pips essentially to the trade. All right, so I can provide these slides to you afterwards. Just let me know. Give me your email address. So yeah, essentially, as you can see here, this example, we've got our entry on the level, stop loss below the low, 100 pips away, like it says in the example. But when we get the instance where the market's gone up, then we can trail to our first break even. When the market goes up, we can trail it here. When it's made 200 pips, we can bank 100. When it's made 300 pips profit, we can bank 200. So we're always going to be the distance between the entry and the stop loss away from the actual trade. Okay, so moving on. So that is exactly how the most aggressive traders will trade reversals. All right. However, the more conservative trader will trade it based on pin bar reversals. Okay, so again, selection timing management, we've got pin bar reversal characterized with the open and close. Bullish pin bar will be the open and close in the top half or ideally the top third of the bar. And if we go with the bearish pin bar reversal, we can have the open and close in the bottom third, qualifying as a sell opportunity potentially. Okay, based on price action. Typically, these pin bar reversals, for a bullish pin bar reversal, I quite like it to be underpinned by a bullish formation on the hourly time frame. If we're looking at the daily, that is the bullish pin bar reversal. Conversely, if we're looking at a bearish pin bar reversal on the daily or the weekly, I would like a bearish reversal pattern to support it on the hourly, purely because time frame correlation gives us that extra heads up that the medium and long-term traders are essentially singing from the same hymn sheet. And that's what we want. Probabilities on our side here. Okay, so if it's a bullish pin bar reversal, we would want to have our entry to go long above the high of the bar plus whatever the spread is quoted by your broker plus an additional pip, with the stop loss just below the low minus spread minus an additional pip. And conversely, if it's a bearish pin bar reversal, we want our entry to go short. If it's off a horizontal level, which has been tested 2 previous times, just below the low, minus spread, minus that pip, with our stop loss above the high, plus that additional pip, just to make sure. Gives the trade that little bit of wiggle room, so to say. Okay, so all intents and purposes, it's nice and straightforward, our trailing technique. If we're going long, we want to trail our stop loss below the low of every second by a bar. There we go, every second by a bar. If it's consecutive, absolutely. There we go, and if we're looking to go short, we want to trail our stop loss above the high of every second seller bar. There we go, sorry. So now we've got essentially the strategies. I'm going to talk to you about some examples here. Okay, so we've covered pound New Zealand. We're going to talk about pound NOK now. There is a third component to this, and I'm going to talk to you about it rather than cover it in your notes. It's the first pullback after we get a key reversal. This pullback is absolutely crucial to qualify the key reversal. Sometimes you don't get it, but when you do, it's a very, very nice heads up to essentially jump on the back of. Okay, so let's talk about pound NOK. I know it's a currency pair that many of you probably haven't traded before. It's one I've been trading for the past few years. It's obscure, yes. You're probably thinking I'm a bit weird for trading it, yes. But I trade it exactly the same way as any other currency pair. And it moves and shakes, it behaves like any other currency pair. And we had a very, very good opportunity all the way back in 2013. And, you know, I've got a good memory when it comes to these trades. But anyway, let's go back in time. This was about April 2013. We had this opportunity right here. Okay, so despite a few previous failed opportunities, or opportunities that just went straight to break even, we had an opportunity to buy on this well-respected horizontal level here for pound NOK. Okay, so what we did was we had our order on the horizontal level, stop loss below previous points where prices braked out before, say around about here. Okay, but on this day here, we had a bullish pin bar reversal characterized, well, by the open and close in the top half of the bar and a tail. So we also had the potential of a double bottom formation here. You see it could be the acceleration point. It's a higher low. We've got a V here, the lower high, but what we could see is a potential acceleration point of it going up and having a reversal longer term. So what we did, even though we were long already on the level here, what we did was we moved our stop loss from here to here, i.e. locking in half or protecting the initial trade by half of what we risked, because half of it was moved to break even, and then we released some half percent essentially to also speculate that this bullish pin bar reversal was going to go long as well. So we placed our order at the break of the high here, stop loss below the low, and then we decided just to trail it like so every second by a bar. And there we go. So for the second trade, like so, the bullish pin bar reversal, we trailed all the way up here. So we made a decent, risking 2%, we made a decent 6% on it, risking 2%. But the trade which really did make the money was the first trade here, where we bought on the horizontal level, the high risk trade, where, you know, sometimes people place their orders on these levels and it's like being in the way of an oncoming train. But after a while, you get the psychology for this, and a lot of people, it's difficult to overcome. But we saw here that the profit potential, reward to risk, was actually pretty damn good. And okay, so if we've got the top of the range here, like so, then you know full well that if we're risking this much in pursuit of this much, the reward risk really isn't that bad at all. Okay? But we need an objective way of trailing, like I said. And this is what we call a ratchet stop. Okay, so we're in on the horizontal level, then it makes sense to trail the equivalent distance the market moves, depending on the distance between your entry and your stop loss. In this case, let's just say tentatively, I don't know off the top of my head, say 71 pips, distance between entry and stop loss. For every, you'll trail the stop loss for every 71 pips. And that's important, just to give it some wiggle room, just in case the market does momentarily go against you, but also to make sure that your profit is banked along the way. Okay, so as you can see, the market did move in our favor rather dramatically as per the first trade, and retrace back. Okay, so we stopped out of that position at a decent profit overall. But there, this is what happened. This is the first pullback, what I was talking to you about. First pullback is generally the 0.618 Fibonacci retracement level, and there are numerous examples of this. Okay, so let me recap. Okay, so you've got the order to go in on the horizontal level, you've got the bullish pin bar reversal, and okay, you've made a profit, you've scaled out, or you know, taken the money, but you've got one more opportunity to take advantage of the first higher low. Okay, and this high low is important if we're looking at a major reversal here. It's a very important event, essentially. And it did correlate with a level back then. Sorry, my levels aren't already drawn in the charts. I had a bit of a problem with technology earlier today, along with the website as well. Let's not even talk about it. Very emotional. But yeah, so 0.618 Fibonacci retracement, bullish pin bar reversal. And this is the last chance saloon to really take advantage of this key reversal before we can really look to take advantage of a trend-based trade within the new trend that's going to form, essentially, after we get these moving average crossovers, which are on the cusp of crossing over at the moment. So true to form, like the standard pin bar reversal strategy we talked about, if you did want to take advantage of the third opportunity to trade this major reversal, then you'd simply place your order at the break of the high, plus spread plus a pip, stop loss below the low, minus spread minus a pip, and then you could trail for every second buy bar, which is absolutely fine, or you can just simply just leave it and just not look at it for a long time. That's the thing. There's always that trade-off between locking in profit feverishly along the way, but then the more aggressive you are with your stop loss through locking in profit along the way, the more upside you could be sacrificing if the market does rebound and suddenly go back in your favor. That's one of those things which a lot of traders struggle with. If you're one of them, then maybe look at parabolic SIR. It's a good way of good objective indicator telling you to move your stop loss, and the closer the market is to the end of the trend, the more aggressive your stop losses management is. But I don't use that. I kind of prefer my methods, to be honest with you. Anyway, so moving on, that was pound knock. Question here, sounds like a good strategy, but how many trades do you get per year? Well, it really does depend. I mean, some of these, this was possibly one of the more memorable ones. I would say between 3 and 4 a year. Out of those 3 and 4, you get one which works very nicely, or 2 that work very nicely. But I would say there are a lot of failed attempts, like ones where you just get out of break even, or nothing really happens, or it's inconclusive. But the art of this one is just having a go every time. It can be very demoralizing when you have an emotional attachment to the outcome of a trade setup. But as long as you know what to look out for, and you can accept that there's no such thing as a guaranteed trade or a perfect trade or a warm and fuzzy trade, then you'll be absolutely fine. Just be mechanical in your outlook and just say, well, here's an opportunity. It might work. If it does, I could make this much. If it jumps through these hoops, I could make even more. But if it doesn't, then fine. At least I had a go, and at least I didn't get killed trying. That's the way to look at it. I know it can be exasperating sometimes, and the market will always do that to you. I'll show you a trade which did that to me recently. Daily bars, Andy, yes, all daily bars. I don't trade on anything smaller than the daily. The reason why is because I like to do other things in the daytime, and I don't really care too much about the market in the daytime. And the daily time frame has a lot of advantages over and above. It's resistant to a lot of noise. The trends are far better established. So are the horizontal levels, far better established. The trading opportunities, far better established. And of course, you can be in the opportunity flow from just trading the daily bars or even the weekly bars in the evening or at the end of the week without having to go boggle-eyed waiting for setup on the 5-minute, 15, 30-minute charts in the daytime. And for me, I tried that before, closer to the beginning of my psychedelic adventures in the market. But you know what? I almost lost my mind. And I'd always, a large number of our clients are people who've gravitated from the intraday chart and have decided to take a more philosophical view of the market. That even if they've got a £1,000 trading account or dollar trading account, who are they to make more than 20% a year? Warren Buffett, I know he's not a trader, he's an investor, but 20% a year is consistently what he makes. All right. So, and here's a fantastic, world famous, legendary investor. Okay. Anyone who thinks that they can live off their $1,000 trading account, making even 20% a year, which is $200. It needs to get their expectations managed, quite frankly. It's very easy for people to fall into this illusion that, okay, I'm a trader, great, I've got this little small pot of money, I'm going to be a millionaire this time next year. It doesn't quite happen that easily, unfortunately, and a lot of people do realize that through their own blood, sweat and tears. So I've got on a bit of a ramble here, so forgive me. I've got another question here. 0.618. I prefer the 0.618 because that's aligned with Elliott wave theory. Typically, you get the first retracement after wave 1 is the 0.618, and then we get wave 3, which is the extension wave, the impulse wave. Sorry. Okay. And what is the best stop loss to use for them? It really does depend, Roger, what the best stop loss is. Are we talking about the horizontal level strategy, where we're just placing the orders on the levels, or are we talking about the pin bar reversal strategy here? Okay, well, when you determine the answer to that, do get back to me, and I'll be able to answer it. So, with this one, we've got some more examples. I want to talk to you a little bit more about the FTSE, September 2014. I know a number of you aren't in the UK, and some of you probably don't even trade the FTSE. The fact of the matter is, it doesn't matter. Just treat this as a vanilla opportunity based on price action, and that's it, really. I mean, this could be any asset class. Like I mentioned before, these strategies work on any asset class, and it doesn't really matter what it is. Okay, so September 2014, there we go. All right, so this actually correlated with the Scottish independence vote, funnily enough, when they had that referendum. Alex Salmon got his verdict in the end. Okay, so a number of traders, just imagine this could be any asset class, would have their orders on the horizontal level here. If they wanted to be aggressive, their stop loss would typically be 50 to 150 points away, as this is the FTSE. It depends, really. Do a visual inspection of it. I mean, 50 is a decent round number. 100 if you want to be extra safe points, as this is the FTSE. I would say 50 to 75 is a good compromise. Okay, so the first order will be on this level here, and those people who were anticipating this trade, a number of more traders have been stopped out of this one, the spike here. So people would be in short who had the generous stop loss already in anticipation of a move back down to the bottom of what is essentially a medium-term range here, horizontal levels, like so. And but people who wanted a slightly more robust price action based setup at the sacrifice of opportunity potential, i.e. in the form of reward, would have waited for the price action based bearish pin bar reversal like we have here. And we had it. Excellent. So the second wave of traders, who are the more conservative ones, would have had that entry just below the low of this bearish pin bar reversal, stop loss above the high, and they would look to trail it for every second seller bar. And then we had the independence vote, and then of course Scotland didn't have their independence. Thank goodness. Insert personal opinion here. But no, you see here, after we had these trades, we had this retracement after a key reversal, 0.618 retracement. I know it's a huge old bearish pin bar reversal, which kind of eclipsed to 50, 786 and the 0.618, but still it's a bona fide lower high to take advantage of. So people in that third wave off this reversal would simply put their orders, the break of the low here, below the low, stop loss above the high, and we'll take it down to the previous, or to the bottom of this range here. Okay, so there we have it. That's a decent reversal. And yeah, it really did fall off. I believe Ebola was getting momentum at this time as well in the media, so I think that was a bit of a precursor to world markets. But you can see here, there are three opportunities we can get into a key reversal, all right? And we've got the levels of supply and demand, i.e. support and resistance. We've got the price action-based reversal, and we've got the first lower high if we're going short, and the first higher low if we're going long. All right, so three opportunities, but I would recommend do not, and I repeat, this is important, do not overexpose yourself to the all three trades naked in your account, because that would be silly. What if they all went wrong? Okay, I would only get into trade 2 if you can move trade 1 to break even, and get into trade 3 if you can move trade 1 and 2 to break even as well. Okay, so you've only got like 1 or 2% or however much you typically risk on your trades exposed to the market at any one time. That's absolutely crucial. Got a question here. How do you utilize moving averages? Okay, well, that's that's a question for another webinar. I mean, moving averages are trend-based, I would say. Well, in fact, they are. I'm not going to even say hypothetically. They are all trend-based. So to qualify a trend, an upward trend, I would simply look to have, say, for example, let's look at Singapore dollar here. Dollar Singapore. We've got order angular separation. So what I'll choose are three moving averages. One, a short, the other medium, the third long-term moving averages. To qualify a trend, I would like order angular separation. Suffice it to say, I would like the shortest term moving average to be above the medium and the long term. I would like them to be a good degree of separation between them, and I would like also them to be pointing upwards in this direction. Okay, so that's how I'd use moving averages. I would use them to confirm a trend. And I would use the 20, the 50, and the 200 exponential moving average here. So that's essentially how I do it. And I'm not really interested in moving averages if in a range-bound market at all. They don't mean anything. So, for example, if we're looking at, let's have a look here. Well, yeah, let's say pound CAD. You know, the moving averages are just squiggling to the side. They're pointing towards, if you imagine the clock face, they are facing towards 3 o'clock. So I'd only be interested in moving averages if we've got a trending market and there's good order, angle, and separation between all three. Okay. Yep, I would re-enter if I'm stopped out once in the trade. That's important. A lot of people don't bother to do this, and this is why they come unstuck. You just need to persevere, especially if I'm stopped out at break even. Happens a lot, but you just need to kind of get used to it. That's the thing. Okay, so we've discussed quite a lot in this webinar. It's been action-packed. You've been very good so far, and you've all been, well, wow, very studious. And I take my hat off to you. It's certainly quite a thing to do it, well, you know, middle of the afternoon on a Friday. And this is why I really want to, after talking about these examples, I just want to really bring your attention to something which I only really offer to FX Street attendees on my webinars, and it's only going to be today only. It's going to be an exclusive. Okay, so we've got the Ultimate program, which I am ahead of, where you can learn to trade financial markets from as little as 10 minutes a day. We've got all the strategies there, weekly market analysis, trade analysis, trade ideas, sorry. We've even got a trader hypnosis course. We've got traders with combined knowledge of 40 years in the market. We've got Julian McCree, who's a veteran, Kaylee as well. We've got pattern recognition software. The online price is $252, but I'm going to give you access for $30, okay, $30. Okay, so you can get everything you need to really kind of like trade in this style, whether you're a trend-based trader or a reversal-based trader. You get everything, basically. You get the analysis, the strategies, access to our traders, pattern recognition software, you name it. And we're going to give you access for $30. All you need to do to get this is go to the website, thelazytrader.com/Forex training, buy the Ultimate program, use the promo code FXStreetMay, lowercase, to secure your discount. That's crucial. You'll get a huge discount. It's, you know, 88% off. we never really do this, but as you've made the effort to come to this webinar, and as you've been so good, and it's been a pleasure mentoring you, please don't prove me wrong in the last 5 minutes. Just kidding. Yeah, we just want to give you this discount because we like to give people a leg up, and it is we like to make it affordable, and yeah, no love lost if you don't take it, but if you don't like it, we'll give you your money back, and that's a promise. In fact, there might even be a few of my clients in the room. Let's have a look. Recognize a few names, maybe? No, I don't. Okay, so any questions, please? I will say reversal trading is a slightly more involved style of trading compared to trend trading, but markets do only trend like 22% of the time. So it does, it is worth your while to essentially get your head around a new strategy or modus operandi. Okay, FX Boyke, regular. I've seen you before, I think. How you doing? So yeah, how do you handle news and economic data releases? Well, I don't really care, to be honest with you, about news and economic data releases. The way I see news releases is they're a catalyst in driving the markets. If I've got a trade opportunity with a reward potential of, say, 6-1 or 5-1, if I'm risking 1% of my trading account, then I know that if the news goes against me, it's going to lose me 1% of my trading account. But if the news goes in my favor, then at least it helps to perpetuate a winning trade, okay? And it helps to perpetuate the 6% I'm looking for in that trade outcome. More questions, do drop us a line. Otherwise, hopefully, key reversal is a candle. Well, 20% a year return. I mean, Warren Buffett doesn't use leverage. That's the key principle of that. Okay, and whereas a lot of 110% happy. Yes, but no. I mean, that's the thing. I mean, because his track record is decades. Okay, and he's been on the scene for absolutely decades. Where a lot of his hedge funds haven't been. That's the difference. I mean, Warren Buffett is one of the oldest, most consistent market veterans today. Okay, so hedge funds, it's all about the bigger picture, really. But if you do have a style of trading which you can just simply set and forget and have working for you while you're doing your other thing, then at least you can be in pursuit of other income streams. Because I'll be honest with you, I love financial markets, but I do find them dry, and I like to mix my life up a little bit. Okay. Sorry, we've got another question. Raja, are we getting live events training that are recorded videos there? Yeah, you've got lots of recorded videos. You've got over 10 hours worth of recorded videos. We will be having events in the future, but most of it's online based. We have webinars. You get weekly market analysis. You get live trade ideas. So all the content is live. You just, in terms of when you mean a live event, you don't go to a seminar room and sit down. Okay. That's the difference. It's just you stream it from home and you can access it any time of the day or night. All right, trade alerts. Yeah, trade ideas, sure. Okay, so FX Boyke, once again, about the data release. You don't have to worry about news, okay? If you trade pursuing high profit potential trades with a decent reward to risk, just see the news as a catalyst, getting your trading outcome faster. If the news goes in your favor, then at least you can potentially benefit from the market going in your favor and the high reward that comes with it. But if the news does go against you, 50-50 either way, then at least you're in control of how much money you're set to lose if you're risking small. Okay? Right. Sound off. Can you all hear me properly? So what I was saying about Warren Buffett is no good. Okay, so what I was simply saying about Warren Buffett is that he has been in the market for a very long time. Retail traders, sure enough, I mean, you get traders out there who make 20% a year, but I'm simply saying my point about Warren Buffett is he's been doing this for decades. absolutely decades. He's a well, I want to say a dinosaur. He's a dinosaur compared to many people, and I'm not saying that in terms of his analysis. I'm just saying that he's been around the block a lot longer than most people. Okay, and retail traders benefit from leverage as well. Okay, so that's what helps the retail traders trading derivatives get such returns. Whereas Warren Buffett doesn't have leverage, as far as my aging memory tells me. Okay. Anyway, you've been absolutely fantastic. Hopefully, see you on board the Ultimate program. Remember, it's only $30. Full money back guarantee if you're not satisfied. Have a great weekend. What do I think of the S&B debacle in January? Well, I know not to really bother going to Switzerland again. Just kidding. No, I thought it was. I thought it was quite boring, to be honest with you. I mean, they could have handled that a lot better. And I was actually very surprised and annoyed about it. Okay. Anyway, take care. Happy trading, and see you maybe next month.